You're listening to What's at Stake. I'm your host, Brian DeAngelis, a partner here at Penta. And we're going to bring you something a little bit different this week. Our friends over at Markets Policy Partners, who many of you will recognize from our weekly Macrocast show, had a great conversation the other day, taking a look at the financial markets and the economy with some predictions for 2023. As we are getting to the end of January, the end of predictions, we thought we would bring you this episode and get a little bit of their insights on what to expect both in the markets and in the economy for the rest of the year. We'll be back next week with a brand new episodes of What's at Stake, but hope you enjoy this show.
2023, we think, is going to be in some ways, sort of the continued legacy of 2022. We've been using this analogy of a hurricane, whereas 2022, the markets were buffeted by the winds and rain of high inflation and tightening central banks across the globe, much abrupt and steeply tighter monetary conditions. Really, it created a very challenging and tumultuous environment for risk assets last year. And we think that that this storm is kind of passing over the investment community, and we're in something of the eye right now. We think that the first quarter of 2023 will represent, a period of placidity, where you have some of the positive aspects and positive dynamics sort of coming to the fore, but really the storm is only halfway over, and we're concerned that through the middle to the second half of this year, the lagged effects of the tightening that occurred through 2022, the lagged effects of the dollar spike, and the persistently and stubbornly restrictive monetary conditions that the Fed and other global central banks are going to continue imposing upon markets with very scant possibility of muscular fiscal support alongside it, is going to create that sort of second half of the storm in the back half of 2023, which is going to be focused on the themes of low growth recessionary conditions around the globe. Maybe not a super deep recession, but a lengthy one with a very little prospect, as I said, of fiscal or monetary support. So talking about what we see for early this year. First quarter, as I mentioned, our eye of the storm kind of thesis is really predicated on the idea that price pressures around the world are waning. It's hard to find evidence that things are reaccelerating, whether you're looking at commodity prices, whether you're looking at the CPI data, whether you're looking at TIPS break-evens, market-based gauges of inflation expectations. All of that are pointing downward. And we think that is commensurate with basically a pretty rapid cooling in price pressures, not just in the U.S. You can see it in Europe, you can see it in China, and other major markets around the globe. At this point, central banks are still sounding very hawkish, but some of them are a little more nimble than others, and you're getting this the tapering off and at least a slowdown in the pace of tightening. We think that the tightening cycles are almost at their apex here. Even despite the Fed's sort of hawkish intonations, there's maybe a little bit of theater in there. There's a little bit of maybe overstatement in there for effect, trying to win their keep markets on their toes, win their credibility back. But we think that ultimately markets are going to look at what they do, not what they say. And we think that the tightening cycles are tapering off here in early 2023. Activity around the world right now is showing signs of weakness, but we think that this period right now, this momentary calm will be, there's still pockets of resilience, and there's still a lot of hope that maybe we can avoid a recession. China's stimulating, and that's part of the positive story for the global economy. China's coming out of this COVID zero. Obviously, there's an exit wave, but on the other side of that, there's expectation that the economy will pick up and provide a boost to global growth. And so nobody is quite sure that everybody thinks a recession's base case, but there's still hope, and we think that this kind of time frame will feature continued hopes for a soft landing or maybe even no global recession. OPEC hasn't doubled down on its tightening of supplies, and so oil prices are half of what they were at their peaks in 2022. U.S. policy uncertainty, it's elevated right now, but the debt ceiling issue is down the road. It's not first quarter, and it's pretty clear that the finely divided Congress isn't going to get any legislation done. The Russian invasion of Ukraine is as bloody and terrible as it is. It seems to be very much in a stalemate. It hasn't escalated recently. The weather patterns have helped dull the effect of Putin's energy blackmail on Europe and the rest of the world. And the crisis in the crypto markets, I don't know if it's blown over. Our expectation, we'll talk a little bit more about that, and there are probably more shoes to drop. But it hasn't metastasized into a major issue for the rest of the global financial markets. So we think, with all those positives in play, we think that it's a decent environment in the first quarter for markets to tread water to go up to whether you get some outperformance in China. We'll talk about some of that, but we think this is a period of placidity when positives come to the fore, but that later in the year, when growth really begins to come down, take a bite out of earnings, and the recession materializes without really much hope of any countermeasures on the policy space globally, that markets are risking another leg down. So I think central to this view is our view on the Fed. We kick it over to my colleague Brendan to talk about our Fed views and what we're thinking about how the Fed is interacting with the macro and how that might translate into other global central banks following their lead.
Right. So lately, the Fed has certainly maintained that hawkish tone, especially this week now that they're back at work and giving speeches again. Everybody that has addressed monetary policy has basically said, we think that the Fed funds rate should be above 5%, and then we should hold it there for a long period of time. We think that they're going to try to stick to the metal as much as possible, but in the end, the data just won't warrant that. Both the inflation numbers are going to come down quicker than their forecasts. The revised forecast in December will justify, and also that the growth prospects for the economy, both here and abroad, are probably weaker than they had anticipated. Although the labor market is likely to stay, fairly tight, but that's much more of a demographic issue than it is anything that has to do with immediate tightening that's going to raise the unemployment rate. So we think that the Fed, by their next meeting at the end of July, the first day in February, will have that scenario where they can then slow down to a 25 basis point hike, and we'll see how high they end up getting there. But I think that their odds of being able to actually hold at that level are much greater if they show restraint now and don't keep over tightening.
Yeah, and if the Fed is on to 25 and maybe a last kiss goodbye sort of the mid-March at the mid-March meeting to get up to 5%, it's still the very end of the tightening cycle here. We think that other central banks will follow suit, and that's going to be at least a near-term positive. But the lesson from the Volcker years, and Chair Powell has said it again and again, if there's one lesson to take, it's not really where the terminal rate is. Volcker says much more to monetary policymakers about the stick-to-itiveness, and the lesson that they take from the Volcker years is don't ease too early. And so we expect that the bar will be incredibly high for the Fed to be cutting rates in the back half of this year. And we think that the disconnect between where Fed fund futures are and the Fed expectations, the Fed's stubborn adherence to tight monetary conditions, is where the biggest gulf in the markets is, and a source of real turmoil. So just to segue onto a couple of other topics, we've talked about China, the end of COVID zero, obviously tantalizing for financial markets. The expectation that they're going to get through this awful period of the exit wave, and then on the other side of it, they're going to be met with increased stimulus and more openness, and that sort of thing. We think that is, that story has been priced in pretty rapidly into mainland assets. Our medium-term view, this is our view on Chinese stocks over the past few years has been, you can rent a rally, but you don't want to hold. These are not buy and hold assets. And I think that, the idea that Beijing has sort of changed its stripes on the tech sector, and these are variations on a theme, but broadly speaking, we don't think that the Chinese assets are a good long-term investment. We think that the ingrained skepticism of the private sector is just going to keep a lid on these things, and that the stimulus that China is engaging in is a lot more in terms of communications rather than real money. We've seen again and again the lack of credit being able to keep up with Beijing's expectations, and we've got another big credit data this week, and it's not clear that China is going to be coming roaring out of this economic trough that it's in. Oil prices, I think, are validating that cautiousness. Whereas Hong Kong stocks are running, you'd expect to see oil prices really ripping here if it was widely accepted that China was going to be back in the business of high growth through the back half of this year and into next. It's not translating in that way into oil prices. We think that the floor is probably in, though. The Biden administration has been a little bit coy about where they're going to buy, but underneath 80, they've declined to do so to fill up the strategic petroleum reserve. But we think that that's coming, and we think that that 80 for Brent is pretty close to a line in the sand. And but we think that there's upside in this eye of the storm here in the first quarter will be given back potentially as growth gets worse around the world. When it comes to cryptos and stablecoins, back to Brendan on that.
So we think that the fallout still hasn't happened on the individual company side. A lot of these companies are so interconnected that I think that there's still a lot more washout there. But that's, I think, contained to the crypto community. From the regulation side, I think that the regulators that be the CFTC and SEC are pretty happy with what's going on, and they would like to just kind of see it wash out before they take serious steps to regulate the industry. On the Capitol Hill side, I think the fact that it took us 15 tries to get a Speaker of the House shows you that it's very unlikely that we're going to have any significant legislation passed, just in general, let alone something as controversial as regulating the crypto industry. And
like a comprehensive crypto bill.
Which would have been difficult, with a super majority of one party. Just because while we say crypto, it is a very diverse, land. But the stable coins is where we are likely to see continued regulation, where that regulation actually a little less crypto regulation and more kind of like money market regulation. Because in the end, it is a financial product that says there's $1 for every one coin. So that legislation is that regulation is in process, and it will continue. I think we'll probably see some clarification in 2023 on that front.
Yeah, and last, and speaking of Capitol Hill, political uncertainty, we mentioned in our intro the debt limit. It's the disorder that we've seen is very disquieting. It sort of foreshadows a potentially tumultuous and potentially disastrous fight over the debt ceiling. But there are some ways around it, and one of them being the discharge petition, which is arcane and complex, but it only requires essentially a majority. The speaker doesn't even have to support it. And it's there are already moderate Republicans, I think, that are looking at this issue, and they just don't want any part of it. So as crazy as the speaker election and some of the early showing of the GOP House caucus, they're not uniformly wedded to a playing chicken over the debt ceiling. There are certainly some moderates, particularly in the Northeast states, and the Democrats don't have to peel off too many to get something like that done.
Right. It's just very difficult to lead with a 5-person majority. I mean, you can always peel off 5-6 people on any vote, but let alone, defaulting on our debt. Where, I mean, I think the speaker election showed you that there is, 15, 20 people in the House Republican caucus that want to do this. So you have about till the summertime before it becomes an issue. But it will become an issue, and we'll decide whether we can nip it in the bud right away, or we have to, shoot until we see the whites of their eyes.
Yeah, government shutdown is more likely. And having been in the government, I can tell you just how annoying and awful that can be. But a government shutdown is a different order of magnitude of risk and something that markets can shake off. But we think that under normal circumstances, but we think that in the second half of the year, when the recessionary conditions are the norm, or in the U.S. or around the globe, the spectacle of a government shutdown and the absolute lack of any sort of fiscal, wherewithal and support, and the Fed continuing to not deny support creates the risk of this of what we see as that back half of the storm that began to hit financial markets last year. So we'll stay tuned. We'll enjoy the current more pleasant conditions in macro for the time being, but we're expecting to hunker down into second and third quarter of this year. Thanks for watching our 2023 Outlook. We're Markets Policy Partners. You can find us on the web at marketspolicy.com. We're on Twitter, and we're on Twitter and LinkedIn, and looking forward to providing you with market insights and policy insights for the new year.